For this session, we will talk about your national budget. So for national budget, of course, we need to define what is a national budget, what are the items or objectives of the national budget, what is budget, and what are the different kinds of budget. Okay, so let's start first and discuss your public expenditure management. Public expenditure management is an approach that ensures the resource allocation is results-based and that government is accountable for its performance. Okay, so this is an anchor to your national budget and your budget process, the public expenditure management. This enunciates that the scarce resource of the government must be properly accounted for and for purposes it is deemed fitted. And again, we check it if ever the use of the particular fund or resources is efficient, economical, and effective. So in your public expenditure management, it says that our resource allocation must be results-based. That's why we will learn soon that our budget is based on the previous year's operation of a particular governmental unit. After that, we try to look at it and see if ever there are changes on that certain amounts. So it is results-based. And of course, at the end of the results, the government must be accountable as to the usage of that budgeted amount to a particular government organization. And during our last sessions, we talk about accountability or the responsibility of a particular person over these funds given to them. So what is the objective of this PEM or the public expenditure management? So first is aggregate fiscal discipline. So when we say aggregate fiscal discipline, we said before that the funds must be with a ceiling or with a particular control mechanism. If you still remember the different control mechanisms on our accounting system, we have your fund, obligation, and CDC. So we said that whatever is allocated, you must only spend within that allocation. So this aggregate fiscal discipline also talks about that way. It says that you must only spend within your means. Spend within means. In short, you spend only based on what is allocated to you, which is also enunciated by your GUM. Next objective of your public expenditure management is allocative efficiency. When we say allocative efficiency, you only spend on what is your priority. So if aggregate fiscal discipline means spend within means or spend within what is allocated to you, allocative efficiency means you spend on your priority. Spend on your priority. This also is initiated by your GUM with its fund accounting. So whichever is allocated, so to whom it is allocated, to whom it is properly prioritized, that must be the particular program or activity that you should spend. And lastly, the objective of this public expenditure management or PAM is operational efficiency. So ensure that your spending or your expenditure must be ultimately for the people and that the money provided by the taxes or the revenues of the government is for the people. So it is the best value for the people. Again, the objectives of PAM, first, aggregate fiscal discipline. You spend within the means of what is allocated to you. So that is receiving. Allocative efficiency, you spend on your priority. whatever is the prioritized project or program based on what is funded or your fund accounting, then that is your priority. Next, operational efficiency. You must ensure that the revenue of the government is at its best value. You use at its best value. So those are the objectives of PM. What are the pillars of PM? First is your medium-term expenditure. So medium-term expenditure, sometimes this is also known as a framework, medium-term expenditure framework. This enunciates that you link your planning, your policy, and your budgeting over your uh, medium medium term, over your medium term. So when you say you link your budget over your medium term, when you say medium term, it is not short term, it is not long term, but it is within those period. Okay. So when I say medium term, normally this is 3 years. Normally this is 3 years. It is not short, it is not long, it is a medium term. So in public expenditure management, it enunciates that to expend or to spend, you must allocate it within 3-year period or at least use a 3-year period for your budget. So 3-year period, results of your operation, we make use of that to your budget, plans, and policies. So based on the 3-year period operation, we make use of that to create this. So we link this and the 3-year period. Why medium term? Because 3 years. Medium term expenditure framework. Another pillar is your organizational performance indicator. So this talks about agency performance vis-a-vis your budget, plans, and policies. If the medium term looks into the years of operation, this talks about your performance itself. So the performance of the government organization. So the expenditures now will be allocated based on agency performance. And the last pillar is the zero-based budgeting. So you will not really look into a particular consideration. Unlike in your medium term, the consideration is the 3-year results. In organizational performance, the consideration is agency performance. In zero-based budgeting, that's why it's called zero-based. You're not basing it to anything. You're not considering anything. You just look into what are your priority programs and projects and then expend or spend or budget based on that. So PEF, therefore, serves as a guideline in the creation of your national budget. That the objectives are this, and we can make use of these 3 pillars in creation. But normally, your national budget is based on a medium-term expenditure. Sometimes they also use zero-based budgeting. And again, you can also mix and match those items. But ultimately, we must meet our objectives: aggregate fiscal discipline, allocative efficiency, and operational efficiency. Take note of the differences of the 3 pillars. 1 and 2, you have a consideration. For the first, there is a term. For the second, there must be an agency performance. On the third, no consideration. That's the differences of the 3. Now, after discussing your public expenditure management, let's go now and discuss budgeting and budget per se. So, how do we define budgeting? Budgeting is a part of the process of assigning financial resources to organizational units so that they can carry their plans and schedule the use of these resources and the results to be achieved outlined in the plan. Planning and controlling. Okay, so here, what we do is we have already financial resources, and this financial resources is uh, to be allocated based on your plans and your schedule of usage of these financial resources. If we take a look for a government, we have your financial resources. We need to allocate this to different programs and activities. That's how we do our budget. But generally, the main concept is we make a budget which consists of our plans for the usage of your financial resources. So what are the purposes of budgeting? So the following are the purposes of your budgeting. First, accountability. Why is accountability a purpose of budgeting? Because we said that government agencies are responsible for the funds or properties allocated to them. Therefore, they are also responsible for the management of the programs for which these funds are to be used. Because we set these funds or resources or these financial resources are to be ultimately allocated to your programs or activities. But before they are used to your programs and activities, these financial resources will be allocated or appropriated to your government agency. And this government agency now will now spend it to these different programs or activities. So it is a tool for accountability because we look into the budget and we look whether those in charge of governance really made use of the budget towards its purpose, meaning towards these programs or activities. For example, we have allocated to Bureau of Internal Revenue a certain budget for the program of uh, collection of more taxes or collection of previous year's taxes that is not yet paid by certain taxpayers or by taxpayers as a whole. So that is the program. So therefore, the allocated financial resource must be only for that program. And if ever the agency did not make use of that for that particular program, therefore, that particular person or that head is subject to a responsibility or accountability. That's why a budget is a tool of accountability. You compare the budget to how it is expend or spent. Number two, it is for management. Why is it for management? Because we said a budget outlines the plans and schedule. Therefore, it helps you to manage on how you will allocate these financial resources. What are the programs? What are the activities? When? What is the cost? What is the result? So that's how you will manage, how your budget helps you in managing your financial resource. And lastly, for economic policy. Why is it for economic policy? First, because budgets helps in reducing inequality. Because what the national government actually do is to get for the amount of the budget per agency, per government agency, per local government, etc. So all items of government, they will give the budget. And the government will look whether this budget is for this, for that, or is it okay or not. Therefore, it is a great equalizer. It is a great equalizer. So it depends again on the programs and activities. Next, it's also it helps into the determination of investment goals. So again, why is it for investment goals? Because it depends on the programs or activities of the government. So if you see that there is a greater amount given on a budget on this particular agency, it means that could be a possibility of the priority program of the government being a priority program that can signal an investment goal. Further, it indicates the direction of our economy as to the use of our resources. Because again, we said ultimately this financial resource will be used to your programs or activities. So that's why one purpose of budgeting is for economic policy. Now, having a knowledge on your budgeting, let's discuss budget. So what is a budget? A budget is an estimate of the proposed expenditures for specified purposes and embodies the means of financing them during the same period. Okay, so if you look at this one, your budget really is now composed of not only the allocation, but also how to finance them. So not only how to spend it, but also how will you source it. So the source being the financing and the spend being the different expenses for your programs and activities. So the following are kinds of budget. First, as to nature, we have your annual budget. When we say annual budget, of course, it covers 1 year. Supplemental budget, it only supplement or adjust the previous budget. So when do we have a supplemental budget? Normally, you will have a supplemental budget only when there is an inadequate budget from your previous budget. So supplement if there is an inadequate budget. Next, we have your special budget. This budget is for special nature. This budget is for, sorry, special nature. Next kind of budget as basis, we have your performance budget. This emphasizes on the programs or services or functions or projects of a particular government agency. While line item budget talks about your different objects of expenditures. So per line item. So let's say for example, the line item is travel, next is operating expense, next is salaries and wages. So you will list that line per line item of expense, and we create a budget based on that. While for performance, you emphasize here the program or services to which you will perform. And based on that program or services, you create a budget. Okay, performance based on program or services, we create a budget. Line item based on the line items of your expenses, we create budget. Next, as to approach. Zero-based budgeting. We already discussed zero-based budgeting. We don't look into any other consideration. No systematic consideration. Just look into your priority programs and activities. Next, we have your incremental approach. In your incremental approach, you will only add or create an increment to a previous budget. So zero base, no basis. So you create a new budget based purely on the program or activities. Incremental, so there is a previous year basis, and you will only add an additional amount to the previous budget. That's why it's called incremental. Last, we have your capital budgeting approach. In a capital budgeting approach, it consists of 2 steps. The first step is a baseline budget. The second step is the allocation of balance. So this is like a residual amount. So how does it work? So let's say you have 300,000. You allocate it first to your baseline budget, and any remainder, that is to your allocation of balance. So how do we set your baseline budget? Your baseline budget is set this way. First, on your agency baseline. First, on your agency baseline. When we talk about agency baseline, you look into the costs or expenses or or the different expenditures of the agency in the performance of their obligations or in the performance of their agency functions. So agency baseline, you look into the cost of agency functions. So normal agency functions. After your agency baseline, you look into your government-wide baseline. Government-wide baseline. So these are government projects which requires priority funding. These are government projects which requires priority funding. So for example, salary adjustment was a priority project of the government. Therefore, since there is a salary adjustment, you need to place that as part of your government-wide baseline because it is a government priority project. So a government-wide baseline, there is a government priority project which now requires funding. Therefore, you allocate something there. Next baseline, financial assistance baseline. So in your financial assistance baseline, these are your ongoing budgetary requirements based on your foreign financial assistance. So payments needed for your financial assistance. And lastly, if ever you're done with this baseline, you now allocate it to your balance. Okay? You allocate it now to your balance will now be allocated to other programs or project. So after you deduct, let's say your agency is 100,000, your government-wide is 50,000, your FA is 25,000, this is 175,000 all in all. So your remainder is 125,000. You will now allocate it to your different programs or activities which you want to allocate. Okay, again, in your zero base, no basis, incremental, previous year, plus you add something. Capital budgeting, we budget your total fund or capital this way. First, will have a baseline budget. What are the components of your baseline budget? Agency baseline, the normal cost of your operations or in doing the functions of the agency. After that, we have your government-wide baseline. Government-wide baselines are government priority programs, needed funding. Next baseline is your financial assistance or FA baseline. So payments or budget requirements based on your financial assistance or different financial assistance. And whatever is the remainder of your baseline will be allocated to your different programs or activities. That is your budget as to approach. Again, budget, you have expenditures. Now, you will look into your different purpose. And at the same time, you need to specify the source. Now, we also talk about your different kinds of budget as to nature, as to basis, and as to approach. Now, having those ideas with you about PEM, Public Expenditure Management, about budgeting, the purpose of budgeting, and budgeting per se, let's now discuss national budget. So what is national budget? National budget is the financial expression of approved programs and projects of the government. So based on your programs and projects, we create a budget, which we already discussed a while back. The difference only is we have a financial resource and we now allocate it to your programs and projects. So this is known as your national budget. So actually, a national budget is the government's estimated income and planned expenditures in a given year. It also talks about income first, and then we have your expenses. So all of this was already discussed a while back in the concept of budgeting and in the concept of a budget. So what really is a national budget? A national budget, therefore, is the estimate of the income and expenditures. And based of this income and expenditures, we allocate it to your government plans. When we say government plans, how do we spend this revenue we incurred to its programs and projects? So here, therefore, we look into the revenue of the government, and based on the revenue of the government, we will now spend it to your programs and projects. So that, my friends, is the definition of your national budget. So we place this definition into one, and we said that your revenue of the government will now be spent for the different programs and projects. So the national budget, therefore, contains two items. We said the source, which is the revenue, and the expense, which are your different programs or projects. So let's talk first to your budget source. Your budget source is your revenues and borrowings. So what are your different revenues and borrowings? So when we talk about your revenues, these are taxes or non-tax. So when we say tax, these are your different national government taxes, such as your income tax, excise tax, business tax. Those are taxes. Non-tax are your different fees and licenses or service incomes that a particular government agency earn based on its licensing requirements. Next, borrowings. So borrowings can either be domestic borrowing or a foreign borrowing. So when we say domestic borrowing, of course, the sources here are issuances of the government itself. Okay, it is not borrowing on. It's not a borrowing on a domestic bank, but it is a borrowing by issuing your own liability. So the government issues, let's say, treasury bonds, treasury notes, and treasury bills. So these are examples of domestic borrowing. When we say foreign borrowing, these are borrowings from different foreign loans. Normally, we have, of course, your different banks from foreign countries or foreign industries, which now lends money to the government. So the budget source of the government, therefore, comes to your debt or equity. Debt from your borrowings. Domestic, take note, domestic does not mean uh, from your banks or domestic banks, but these are borrowings of the government by issuing its own liability. So what are the own liabilities of the government? Bonds, notes, bills. Normally, you know this one as treasury items. And then foreign borrowings, these are borrowings from foreign entities. Sir, why don't we borrow in our domestic banks? Actually, we borrow from our domestic banks, but generally, those are not generally source of our budget. Our main source are first borrowings from our own issuance and then borrowings from foreign countries or foreign industries. In case that we need money and we cannot exact from this debt leverages, then we can borrow from your domestic banks. But they are not considered domestic borrowings per se. Okay, after knowing your budget source, we go to your budget expenses. Your budget expenses are the following. First, operational expenditures or OPEX. So these are appropriations for the conduct of normal government operations. So expenses on your normal government operations, these are your OPEX. Another expenditures by class based on your budgeted expense are your capital outlays. These are appropriations for the purchase of different capital outlays which are added as assets of the government. So normally capital outlays are long-term assets of the government. Next, we have expenditures on your lending. So these are advances by the national government for your debt and loan outlays to government corporations. So what we do is we just don't give money, or the government just not does not only fund money. Sometimes it also lends money. So if ever we lend money, then that is part of our budget expense. Actually, it's not an expense because you can consider this as an asset receivable, but we only say it is a budget expense because that is how we spend the national budget. Next is amortization. These are expenses of the government in the payment of loans or borrowings. So these are generally the items of our national budget. Normal government operations, which includes the programs and activities, capital outlays, if ever the government purchases long-term assets, lending, if ever the government will lend money to other institutions, and amortization, the payment of loans or borrowings, including their interest. Now, the question here in your budget is that what if your source will be lesser than your budget expense? If it is lesser, we call this one as a budget deficit. Budget deficit. As a general rule, what we only do as a source is the revenue itself. So we maintain our revenue to your expenses because we don't want to have a deficit. But in case there is a deficit, we now incur loans and borrowings. Take note of that. Generally, we match only our revenues to your budgeted expenses. Your revenues generally comes from your taxes and your non-taxes. However, if in case there is a deficit, we create loans. Now, we enter loans, either domestic or foreign borrowings. But if the source is greater than your expense, then there is a surplus. There is no problem with that. The current happening here in the Philippines is that we are normally working on a deficit. That's why we create foreign loans aside from creating domestic borrowings. So if you are abreast with the current events, you know that we have a lot of foreign borrowings. And you know that the payment of that foreign borrowings is still cut short to our to the usage of our revenues. As you see, we budget it under your amortization. Take note, we are not only paying the amount of our loan, we are also paying the amount of interest on that loan. That's why for the Philippine economy to boost, we must boost our revenue. We must boost our revenue. As you can see, by boosting the revenue, what they did is to change different taxes, increasing and decreasing some tax rates, but ultimately, what happened is it also increased some expenses. But anyway, it is up to our national government and our economists to look into a proper balance of your budget source and budget expenses. As accountancy students, what we only look into is that there must be no deficit and that particular budget is allocated to these following items and are properly used and not defalcated. So that items are that composes your national budget. Now, what are the components of national budget? So the components of national budget are, first, we have your new general appropriations. When we say new general appropriations, this is the General Appropriation Act. So this is the new budget passed by the government. Next, you have your automatic appropriations. These are appropriations provided under specific laws or a certain type of expenditures. We also have your continuing appropriations. These are appropriations generally on your OPEX and capital outlays. Why are they continuing? Because, of course, our operations are continuous and some capital outlays are also continuous. Therefore, if we try to look at it, a while back we said that the items are your OPEX, capital outlays, lending, and debt amortization. Debt amortization is part of your specific loss. Why? Because this particular amortization is is uh, this particular amortization must be automatically set or appropriated. Why? Because it is based on a specific contract which the government must adhere into. While lending can be on a GAA, OPEX and CO can be on GAA. Furthermore, they can be in your continuing appropriations. So generally, these are the items of your national budget. And take note, this national budget covers the totality of your national government agencies. So when we say totality of government agencies, you already know what is a government or the national government. Take note, we said your national government is not only the executive, judiciary, and legislative, and the CONCOM, but all the three. National government, LGU, and GOCCs. So we go now to your fundamental principles of your fiscal operations. Take note, once there is a budget already, it covers all of the national government. And the budget normally has a source, which is our revenue. If the revenue is not enough, then we can have a deficit. We can also source from our borrowings that can be domestic or foreign. After such, we must already spend it to which it is budgeted. We said we can allocate it into four. We said it can be under expense class, current OPEX, capital outlays, lending, and amortization of your debt. Or we can also allocate it as part of your appropriations. First, we have your general appropriations. Next, your automatic appropriations under specific laws and automatically set contracts such as your debt amortizations. Also, we have your continuing appropriations, which just continue to be valid based on your previous appropriations, such as your OPEX, because we have continuous operations, and capital outlays as to your maintenance of your capital outlays. Now, after knowing setting of budget, the source, and the components of the budget, we look now into the fundamental principles of fiscal operations. So fundamental principles of fiscal operations sets a standard as to how we make use of our budget and how we spend that particular budget. First, no money shall be paid out any public treasury or depository except in pursuance of an appropriation law or other specific statutory authority. So you already know this one. There must be first an appropriation, which is an allocation on that particular fund or property, and before we could spend it, it must be allocated to that government agency. Next, government funds or property shall be spent or used solely for public purposes. Ultimately, we said who benefits public purposes, the rendering of service of the government to the public. Next, trust funds shall be available and may be set only or spent only for a specific purpose for which the trust was created. We already know this one. We can create a special fund which is only for a special purpose or for that specific purpose, and you cannot spend it You cannot spend it unless it is for that purpose. Next, fiscal responsibility shall, to the greatest extent, be shared by all those exercising authority over the financial affairs, transactions, operations of the government agency. We already talked about this one. We do not only look into the person responsible, but also look into all persons accountable. When we say all persons accountable again, these are all persons to whom we entrust the fund or property. Next, disbursements or dispositions of government funds and property shall invariably bear the approval of the proper officials. So this is a control mechanism. Before a disbursement, there must be an approval. It is not it is not just that it is already allocated or appropriated that you can spend it. You must first seek approval for disbursement. That is normal to any business also. Number six, claims against government funds shall be supported with complete documentation. So you already know that we have these obligations as part of our process. Normally, when you enter into a government contract, they normally don't buy through cash. It is always through an obligation or a liability. And before you can claim that obligation or payment of obligation, there must be a complete documentation and there must be an approval for the disbursement on the payment of that obligation. Number seven, all laws and regulations applicable to financial transactions shall be faithfully adhered to. So, of course, you don't want that you will not adhere to laws and regulations because once you do not adhere to laws or regulations, what will happen to the government official or government agency? They will be held liable. When we say liable, it can be criminal, civil, or administrative. Criminal, there are chances that they might be jailed at the same time paying a penalty. Civil, normally damages. Administrative, normally these are penalties such as no more no more amount of what do we call this one? No more amount of funds to be taken out once you retire. We call that your retirement fund. So there will be no more payment of retirement fund. Aside from that, no more holding of office, no more hold. You cannot also run for public office, meaning you cannot run for elections. So those are certain administrative liabilities. So criminal, civil, and administrative. Those are the chances if ever you will not adhere to laws and regulations. Number eight, generally accepted principles and processes of accounting as well as of sound management and fiscal administration shall be observed, provided they do not contravene existing laws and regulations. Actually, aside from Oregon, we also have your general accounting principles. We still follow some general accounting principles such as your global entry system, etc. Okay, so these fundamental principles of fiscal operations helps us not only as to the budget per se, but also how we spend the budget soon, on how we make use the funds and properties. Now we talk about your national budget system. So we already know your national budget and budgeting. We go now to your national budget system. So what is our national budget system? It consists of the methods and practices of the government for planning, programming, and budgeting, include the adoption of sound economic and fiscal policies, and the execution of programs and projects geared towards the accomplishment of political, economic, and social objectives. So here, your national budget system, therefore, does not only talks about the allocation of the source to your different expenses or programs or activities. It also is concerned about sound economic and fiscal policies, including accomplishment of political, economic, and social objectives. Therefore, budgeting under our national budget system is not only purely fiscal in nature, it must always be geared towards the development of our economy, whether that is only economic factor, but also social factors and political factors. So, what then is the concern of our national budget system? The concern of our national budget system is the availability and use of money to provide the services required or expected from the government. We already know that. We have a source and we spend it to different items of our budget. But what is the objectives or what are the objectives of the national budget system? First, to carry out your government activities under a comprehensive fiscal plan. Next, to provide a periodic review and disclosure of the budgetary status. So for the first one, you already know that one. We said that is for your operation. That is for your operation. So it looks into your operational efficiency, fiscal discipline, allocative efficiency. You already know that. Now, as to the second one, periodic review and disclosure, this talks about accountability and management. This talks about accountability and management. Accountability as to those responsible for the management of the funds or resources of the government, and management as to the proper management of the budget and the funds or resources. That's the end of our national budget. Again, what we talk about national budget, we have a source, and from that source, we try to spend it now to your different expenses. But when we talk about our national budget system, it does not end there. It does not end there because we still need to take a look at the following items. What are those? Your different objectives. And the objectives are your objectives as to political objectives, social objectives, and economic objectives. Furthermore, as we spend this budget, we are guided by different fiscal policies. We are guided by different fiscal policies. And in the creation of your budget, our main mechanism is your PEM or Public Expenditure Management. So that is all for your national budget.